Hello everyone, welcome back to the Investing Iguana, where I share with you tips and tricks on how to grow your money and achieve financial freedom. I'm your host, Iggy, and today we're going to talk about a very important topic, CPF versus SRS. Which one should you use to save tax? If you're living in Singapore, you probably know that CPF and SRS are two schemes that can help you save for your retirement and reduce your taxable income. But do you know the differences between them and how to use them effectively? In this video, I'll explain what CPF and SRS are, how they work, and how you can decide which one is better for your situation. But before we get into that, please remember to like this video, subscribe to my channel, and hit the bell icon so you don't miss any of my future videos. And if you have any questions or comments, feel free to leave them below and I'll try to answer them as soon as possible. Alright, let's get started. What is CPF? CPF stands for Central Provident Fund, and it's a mandatory savings scheme for all Singaporeans and permanent residents. Every month, a portion of your salary goes into your CPF account, which is divided into three sub-accounts: Ordinary Account, OA, Special Account, SA, and MediSave Account, MA. Your employer also contributes a matching amount to your CPF account. The main purpose of CPF is to help you save for your retirement, healthcare, and housing needs. You can use your OA savings to buy a property, pay for education, or invest in approved financial products. You can use your SA savings to invest in approved financial products or top up your retirement account, RA, when you reach 55 years old. You can use your MA savings to pay for medical expenses or insurance premiums. The good thing about CPF is that it offers attractive interest rates on your savings. Currently, your OA earns 2.5% per year, your SA and MA earn 4% per year, and your RA earns up to 6% per year. These interest rates are guaranteed by the government and are higher than most bank deposits or bonds. The bad thing about CPF is that it has strict rules on how and when you can withdraw your money. You can only withdraw your OA savings after you have set aside the Basic Retirement Sum, BRS, Full Retirement Sum, FRS, or Enhanced Retirement Sum, ERS, and your RA when you reach 55 years old. You can only withdraw your SA and MA savings after you reach the statutory retirement age, currently 65 years old, or meet certain medical conditions. And even then, you can only withdraw a monthly payout from your RA under the CPF Life Scheme, which provides you with a lifelong income. What is SRS? SRS stands for Supplementary Retirement Scheme, and it's a voluntary savings scheme for both Singaporeans and foreigners. You can open an SRS account with any of the three local banks, DBS, OCBC, or UOB. You can contribute any amount of cash to your SRS account every year, up to a maximum of $15,300 for Singaporeans and PRs, or $35,700 for foreigners. The main purpose of SRS is to supplement your retirement income on top of your CPF. You can invest your SRS savings in a wide range of financial products such as stocks, bonds, unit trusts, insurance policies, etc. You can also withdraw your SRS savings anytime you want, but there are some penalties if you do so before the statutory retirement age. The good thing about SRS is that it offers tax benefits on both ends. When you contribute to your SRS account, you get a dollar-for-dollar tax deduction on the amount contributed, up to the maximum limit. This means that if you earn $100,000 a year and contribute $15,300 to your SRS account, you only need to pay tax on $84,700 of your income. When you withdraw from your SRS account after the statutory retirement age, only 50% of the amount withdrawn is taxable. This means that if you withdraw $10,000 from your SRS account in a year, you only need to pay tax on $5,000 of it. Alright, now that you know what CPF and SRS are, how do you decide which one to use to save tax? Well, it depends on your personal circumstances and preferences. Here are some factors to consider. A. Your nationality. If you're a foreigner, you don't have a CPF account, so SRS is your only option. If you're a Singaporean or PR, you have both options, but you need to weigh the pros and cons of each. B. Your income level. If you're a high-income earner, you may want to use both CPF and SRS to maximize your tax savings. You can contribute up to $8,000 a year to your CPF SA via the Retirement Sum Topping Up (RSTU) scheme and get a tax deduction for it. You can also contribute up to $15,300 a year to your SRS account and get another tax deduction for it. This way, you can reduce your taxable income by $23,300 a year. If you're a low-income earner, you may not need to use either CPF or SRS to save tax, as your income may already fall below the taxable threshold of $20,000 a year. C. Your retirement goal. If you're aiming for a higher retirement income, you may want to use both CPF and SRS to boost your savings. You can invest your CPF OA and SA savings in approved financial products to earn higher returns than the CPF interest rates. You can also invest your SRS savings in a wide range of financial products to earn higher returns than the SRS interest rate. This way, you can grow your retirement nest egg faster and bigger. If you're aiming for a lower retirement income, you may want to use only CPF or SRS to save enough for your basic needs. You can leave your CPF OA and SA savings in the CPF accounts to earn the guaranteed interest rates. You can also leave your SRS savings in the SRS account to earn the low interest rate. This way, you can preserve your capital and avoid market risks. D. Your liquidity needs. If you need more flexibility and access to your money, you may want to use only SRS or none at all. You can withdraw your SRS savings anytime you want, but there are some penalties if you do so before the statutory retirement age. You can also choose not to contribute to either CPF or SRS if you don't want to lock up your money for the long term. This way, you can have more cash flow and liquidity for your other needs. If you don't need much flexibility and access to your money, you may want to use only CPF or both CPF and SRS. You can't withdraw your CPF savings until you reach 55 years old or meet certain conditions. You can also withdraw your SRS savings only after the statutory retirement age or pay a penalty. This way, you can force yourself to save more and avoid spending impulsively. As you can see, there is no one-size-fits-all answer to whether you should use CPF or SRS to save tax. It depends on your individual situation and goals. The best thing to do is to do some calculations and projections based on your income, expenses, tax rate, expected returns, etc., and see which option gives you the best outcome. In summary, CPF and SRS are two schemes that can help you save for your retirement and reduce your taxable income. They have different features, benefits, and drawbacks, and you need to consider your nationality, income level, retirement goal, and liquidity needs to decide which one to use or how to use both effectively. If you want to learn more about CPF and SRS, or how to invest your savings wisely, you can check out some of the links in the description below. You can also visit the official websites of CPF and SRS for more information. If you found this video helpful, please hit that like button. It really helps us to understand what kind of content you want to see more of. And don't forget to subscribe. Here at the Investing Iguana, we're dedicated to helping you navigate your financial journey with confidence and clarity. And guess what? There's plenty more where this came from. Stay tuned for our upcoming videos, where we'll tackle other interesting financial topics like the best investment strategies, understanding the stock market, and how to make your money work harder for you. As always, we're thrilled to have you as part of our Investing Iguana community. Your support helps us keep producing free content like this. Remember, every like, share, and subscribe goes a long way. Thanks for joining us today. Keep investing, keep growing, and we'll see you in the next video. Bye for now.